The unemployment rate went down this week. That sounds like good news. It is not. 1 million people walked out of the workforce to make that number look better, and almost nobody reported it. Let me show you what is underneath. I'm Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. This is your weekend update for the week of August 7, 2026. The jobs report was weak in every single place. The July unemployment report came out Friday morning. The market expected 80,000 new jobs. We got negative 23,000. That's a miss of more than 100,000. Then it got worse. May and June were both revised down by a combined 103,000. Look at what happened to May. It was first reported at 172,000. Then it was cut to 129,000. Friday, it was cut again to 63,000. That is about a third of the jobs we thought we had. June started at 57,000. It's now 20,000. Add it up. Between this month's number and the revisions, that's 126,000 jobs gone. Now here's the part that gets misread on television. The unemployment rate did fall from 4.2% to 4.1%. But the survey that produces that rate showed 87,000 job losses in July and about 700,000 over the last 2 months. So how does the rate go down while jobs go away? Because 264,000 people left the workforce in July. Since May, about 1 million people have stopped being counted at all. You're not unemployed if you stop looking. The rate fell for the wrong reason. You can see it in one more number. The share of adults working or looking for work slipped to 61.4% from 61.5%. Same story, told a different way. The all-in unemployment rate, the one that adds those people back, was unchanged at 7.9%. That number tells you more than the 4.1% everybody quotes. One more piece. We lost 106,000 full-time jobs. The gains were in part-time work. That's not the mix you want to see. Where the jobs went, the damage was not spread evenly. And where it landed matters to you. Leisure and hospitality lost 40,000 jobs. Retail lost 19,000. Local government education lost 50,000. And some of that is likely the summer timing issue with school closures. The one area that gained was private education and healthcare, up 25,000. That has been carrying this report for more than a year now. Look at that pattern. The parts of the economy that respond to interest rates and to what families spend are shrinking. The part that does not is the only growing part. That's a weak report wearing a decent disguise. Your paycheck is not what is driving prices up. If you have been told that raises are what keeps inflation high, the data says otherwise. Average hourly earnings rose about 0.1%. Over the past year, wage growth slowed from 3.4% to 3.2%. Weekly earnings slowed from 3.8% to 3.5%. We also got productivity numbers this week. Workers produced 1.4% more in the second quarter, more than double what was expected. The cost of labor per unit of work rose just 1.3%, well below estimates. More output, slower raises. Whatever is pushing prices up right now, it is not the American worker. There was one more piece of good news Friday. What people expect inflation to be a year from now eased to 3.6% from 3.7%. That number matters more than most people realize because expectations have a way of turning into reality. Where rates closed. The markets closed for the week, so these are the final numbers. The 30-year conventional finished at 6.74%, down 3 basis points on the day. The 30-year jumbo last printed at 6.9%. The 30-year FHA at 6.33%, and the 30-year VA at 6.35%. These are national averages from Mortgage News Daily, not an offer to lend. The 10-year Treasury closed at 4.64%. Last week, it was 4.74%. That's a 10 basis point improvement, and mortgage bonds gained about 1/4 point on the day. The weak jobs report did that. Oil came down, and that matters to you. Oil closed at $76.91 a barrel, down 38 cents on the day. Put that in context, 1 week ago it was near 86. 6 weeks ago, it was near 68. So we gave back a good piece of that spike. And the reason is that tensions around the shipping lanes in the Middle East have calmed down. Why should you care? Because oil shows up in your life twice. You feel it at the pump within days, then it shows up in the inflation reports months later. And those reports are what move your mortgage rate. Cheaper oil now is a quiet win for rates later. What comes next for rates? The 10-year yield has been stuck in a range roughly between 4.2% and 4.8%. At 4.64%, we finished the week closer to the top of that range than the bottom. The level to watch is 4.39%. That is the point where the trend flips from up to down, and we closed about 25 basis points away from it. Two forces are pulling against each other right now. The new leadership at the Fed has signaled it would be willing to raise rates in September if the coming inflation reports run hot. That is the risk on one side. On the other, calmer oil markets pull rates lower. So this is a tug of war, and neither side has won it yet. Hot inflation numbers keep us pinned near the top of the range. Cool ones open the door to 4.39% and below. The reports we get next week will settle more of this than anything the Fed says between now and September. Featured this week, we put a full set of resources up for you. Here are the ones I want to point out to you. Number one, from chasing a rate to reading a 30-year map of your own housing market. Number two, everybody watches the mortgage rate. Almost nobody watches the card at 20%. Number three, the market has a clock. So does your household. Only one of them matters. And finally, number four, your tax return says you cannot afford it. Your bank statements say otherwise. There are several more posted beyond these four. All of them are on the right side of your screen or below the video, depending on the device you're using. If your tax return does not tell your whole story, that second article is about the card at 20%, and I want to come back to it in a minute. First, the fourth one. We keep a selection of loan programs for people whose tax returns do not show the full picture of what they actually earn and can comfortably repay. That may well be you. This week, I'm highlighting the bank statement loan. Here's how it works. We use the income you actually deposit into your bank account, not the number left at the bottom of your return after your CPA or tax planner takes every legal deduction to lower what you owe. Think about who that is. The business owner, the contractor, the commission salesperson, the person whose CPA just saved them a fortune in taxes, who then gets declined at the bank reading that same return. Both things can be true at the same time. Smart tax planning and a strong ability to repay can live in the same household. You just need the right program. Strategy beats rate always. The details are at rsrlinks.com/bank statement. The debt nobody is watching, back to that card at 20%. One number from Friday did not make the news. Americans took on $14.17 billion in new consumer credit in June. The forecast was $10.5 billion. We borrowed almost 35% more than expected. Everyone in the country is watching mortgage rates. Almost nobody is watching the card sitting at 20%, and that card is the most expensive money in your house. Which brings me to a tool, and it is free. It's called Debt Done Date, and you'll find it at rsrlinks.com/DDD. You enter every debt you carry, your mortgage, auto loans, student loans, credit cards, and any unsecured debt. We then show you several different ways to strategically pay all of it off and the exact date each path gets you to zero. Most people have never seen every debt they own on one page with a finish line attached. It changes how you look at every dollar. Take 10 minutes this weekend and run yours. Next week on the calendar, next week is an inflation week. All times are Pacific. Tuesday brings existing home sales at 7 a.m. with a forecast of 4.09 million. Wednesday's the big one, consumer inflation, the CPI report at 5:30 a.m. Prices are running 3.5% higher than a year ago, and the core number is 2.6%. Housing costs make up roughly 44% of that core number, so another soft housing reading would help us a great deal. Thursday brings wholesale inflation, the PPI report, at 5:30 a.m. along with weekly unemployment filings. Friday brings retail sales at 5:30 a.m. and consumer sentiment at 7 a.m. If inflation comes in cooler than expected, the 10-year has room to move toward that 4.39% level, and mortgage rates tend to follow. If it runs hot, September gets interesting. Bottom line, everything I mentioned today, the featured articles, the loan programs, the tools on the right side of your screen or below the video, depending on the device you're using. That's the weekend update. We appreciate you listening, and we'll speak to you again next week.